Welcome to Commercial Real Estate Pro Network's CRE Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is John Stoeber. John uses his background in finance to build financial models and analyze multifamily properties from a number of different perspectives. He currently owns and operates 34 apartments in Little Rock, Arkansas, and is looking for deals in growing markets. And in just a minute, we're going to speak with John about partners, deals, and the skill set you need to do your first deal. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do. You can like, share, and subscribe. And as always, we'd love to hear from you. Please leave a comment. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, John. Welcome to CREPN Radio.
Hey, Darren. Thanks so much for having me. Excited to be here today.
Well, I'm looking forward to our talk. Before we get started, if you could share with the listeners a little bit about your background.
Yeah. The short story is I'm just a spreadsheet jockey, but I went to college for, accounting and finance. I got a double major and I was on that W-2 path pretty much since the day I was born. The entire last semester I'm in college, I'm looking for a job and I finally get an offer. And at the time there was no remote work. So I look at the number of vacation days I'm going to get. I look at the salary and I'm just kind of like, this isn't going to work. This isn't going to work for the lifestyle I'm trying to build, which led me on the search for passive income. And on that search, meaning Google, I kind of fell down the real estate rabbit hole. I'd heard about other investment options like bonds, CDs, dividend stocks, but I was going to need like $1 million invested at least just to make like 50 grand a year of passive income. Whereas in real estate, you get tons of other ways to accumulate wealth besides the cash flow. You get principal pay down, appreciation, tax advantages. And I mean, I'd always kind of been interested in real estate before getting this job offer, but I'm incredibly not handy. Like I shouldn't be allowed to touch a hammer. So that it always scared me away from it. But as I climbed down the rabbit hole, I started to realize okay, I can develop systems. I can hire a lot of this stuff out. So I can do that. So fast forward like 9 months, I've graduated college. I'm working my first job and I had this really long commute from Washington, D.C. up to Baltimore, Maryland, and I wanted to get rid of it. So I ended up buying a 2-unit, a duplex to do what's called house hacking, which is where I had 2 apartments. I rented one of them. I lived in the other. And then my apartment also had a basement. So I rented out the basement. So I was living for free. And my down payment on this owner occupied duplex was like less than 5 grand. And that included like all the closing costs, like everything. Like I bought a property for less than 5 grand, which is like 4 or 5 months rent in Baltimore, like in these coastal markets. So that was awesome. And I had to evict my first tenant, which was kind of nerve wracking because she knew right where I slept. But, I evicted her. I put a new tenant in there. I put a tenant in my basement, and all of a sudden I'm living for free. And I kind of caught the bug at that point. So then I'm like, okay, I wanted to graduate and do what's called the BRRRR method, which stands for buy, renovate, rent, refinance, and repeat. It's kind of like instead of fix and flip, it's fix and rent. And then you just refinance all the money you put into the deal back out. So that meant I had to tackle this inability of mine to manage contractors and construction. Because like I said, I shouldn't even be allowed to touch a hammer. So I team up with a couple partners and we go and we take the biggest, baddest flip down in Baltimore City where you'd have 100-plus-year-old homes, then they're just absolute shells. So we had one of those where it's all new mechanical systems, new roofs, had to dig out the basement, and then everything else that comes along with that. And that was a huge, huge learning curve for me. like honestly was not ready for that big of a project at the time. But while I'm doing that project, one of my partners, he had a fourplex. I had this duplex. And he ran into some issues with this fourplex where like he had to do this really long eviction. I had to do an eviction and I was dealing with like a couple tenant headaches, but like the light bulb just kind of went off in our head. We're like, whenever we make a mistake with the fourplex or the duplex, like really our tenants pay for it. So like as he'll tell you, he's like, my tenants paid for my eviction. Whereas when we missed something in our rehab budget, like that came out of our pockets and our bottom line. So like while we're doing this flip, we're just kind of like, like let's just go buy apartments and like bigger multifamily. It's what we want to do anyways. And like we really don't want to work our way up through like fix and flip and single family. And yeah, that kind of started this entire journey.
Got it. Got it. Well, you've got quite the library there of experience there with, being a landlord with the tenant next door to doing a major flip. I mean, I'm curious on that big flip you talked about. How long did that take you to do that from acquisition to? I'm assuming you sold that.
Yeah, we sold that over a year ago. I mean, we we thought it was going to take like 3 months to do the entire thing, and it took over a year to go from start to finish on that thing.
All right, but did you come out ahead in the end there? Did you make a?
No, we
Uh,
we did not come out ahead, unfortunately.
so is that more of like you didn't buy it right, or what was just over cost overruns, or your budget, or what
It was
was
kind.
the?
I mean, it was kind of everything. I mean, I don't think we necessarily bought it wrong, but yeah, like we definitely came in low on the rehab budget, and then the amount of time that we held it, just like those holding costs, and especially because we bought it with a hard money loan, like they really eat into your profit margins. So when you're
Right,
thinking that it's going to be like a 4 to 6 month hold, and it ends up being over 12, I mean, those holding costs will crush you.
right, right. Well, you survived, right? That's
Yeah,
the. I've always kind of looked at some of the opportunities I've jumped into as it won't kill me
right.
if it goes wrong, but lessons that I'll never forget. So,
Hmm.
but all right, so you kind of had the taste of the flip, didn't like that, like the being a landlord, but realized being in something larger than a duplex or a fourplex was really kind of the way to go. You mentioned your partners on there. Did you end up partnering with your flip partners to get into larger multifamily?
So I still work with one of them, the guy who owns the fourplex, but on the 34 unit portfolio, we're doing a reposition right now. He's not part of that deal, but we're still looking for deals together.
Okay. You mentioned you're a spreadsheet junkie or jockey. I don't know. Did you say jockey or junkie? I think it
Yeah,
was
jockey.
jockey. I say
Same
jockey.
same thing. I might as
Yeah.
well be a spreadsheet junkie because I'm always
Eh,
on them.
right. 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 Um, so let's talk a little bit about the what you saw in the 34 and what you're doing with the 34 unit property.
Yeah. From like a financial perspective.
Yeah, no, let's
Yeah.
tell me what was it? Tell us about the property and what you saw, and are you doing a value add
Oh yeah.
reposition or what? Tell us all the juicy details here.
Yeah, we're doing actually a really big value add. I mean, this was a distressed property. The person who previously owned this was just completely mismanaging it. I mean, no records or anything didn't screen the tenants. But if you look at like these larger commercial properties, like as a flip, like it's really not that much different from a single family flip or a burr. It's just the way you calculate some of the numbers are different. So like if you're flipping or you're doing a burr on a single family house, you're going to have your acquisition costs, your renovation costs, and then your ARV, which stands for your after repair value. And like the general rule of thumb is, you want your acquisition costs and your renovations to be 70% of what you're going to sell it for. And then that leaves some room for like, realtor commissions, holding costs, soft costs, as well as your profit margin. It's really not that much different when you're looking at a multifamily property. The key thing though is the way you calculate your sales price. So like with a single family house, you're going to go off of sales comps and you don't really have a ton of control over like stretching the market. If similar homes are selling for 200K, like your home is going to sell for 200K. In multifamily and commercial real estate, though, the value is based off of the net operating income. And sales comps do come into play, but like on a basic level, you're going to take the net operating income of that property, which is all of the expenses except the mortgage, and then you're going to divide that by the cap rate in the market. So let's say you're making $100,000 of net operating income, which again is cash flow before your mortgage, and that market cap rate is a 6%. You're going to take 100K divided by 6%, and that's, I should know this number. It's like, I think it's less than $2 million. It's probably like $1.8 million. But so that's your ARV, and then you're going to take your acquisition costs, your renovation budget, as well as the other costs, and you're going to see if you have a spread. So the thing with the Little Rock portfolio is we ended up buying 34 units for $800,000, which comes out to 23.5K a door. We're putting 5 to 10K of rehab into each unit. They're renting for 650 to 700 right now. It's all 1 and 2 bedrooms. And based off the cap rate and the other sales comps in the market, we should be able to sell them for 45 to 55K a door. So it's like you're all in for probably like 35K a door, and you're selling them for 45 to 55. It's like there's a huge spread on that. And then you're just calculating your other numbers too to make sure that it's going to cash flow if you refinance it.
Got it. In Little Rock, was there an attraction to the market, or was it more of like a property you found, or?
Well, I had been looking in Arkansas for apartments before. I really like Northwest Arkansas, where you have Bentonville and the university up in Fayetteville. I mean, like that area is booming. Little Rock is actually never on my radar. I mean, like it's a pretty stable market. It's a little higher in crime, but I wouldn't say it's like, one of these high growth markets. I just had a great opportunity come my way from someone I trusted. She had a deal under contract and she needed money and partners to put the deal together. And it's kind of like your first job too, or at least for me. Like I didn't have a ton of options coming out of school. I had to take a job so I could get experience. And it's the same thing with this portfolio where it's like not my ideal criteria, but it makes sense. And it's just a way for me to get experience and start racking up some wins.
No, it makes complete sense. So tell us about, you mentioned, do you have a partner on this one then? Did you mention somebody had a deal and needed help, or?
Yeah, so I have a few partners, but she had a deal. I mean, she had this deal locked up back in March of 2020. It fell out of contract because COVID hit, and the partner she was going to buy the deal with ended up bailing. She put it back under contract, and then she had to raise money, and she just had to. I mean, she had to put a team together because she didn't have all the money to just buy it herself, and she lives in Salt Lake City, so it's not like she's in the market. And I can run the numbers. I can kind of act as like, I guess, like a financial analyst or a CFO on the project to add value, and like I had some money to put into the deal.
Okay. And so did you come in as is it a joint venture? Did you syndicate, or how did you guys put it together?
Yeah, so this is just a joint venture. It's not a syndication.
Okay. And so does everybody have different skill sets, or are you guys missing anything? Have you been able to?
No, I mean, so I'd say the skill sets are pretty well rounded. I mean, one of our partners, well, they're a married couple, but they're like one group. They have a lot of experience managing contractors and renovations, and they also live closest to the property. So they're like the boots on the ground and the construction managers. My partner who found the deal, I mean, that was basically her role. Like she found the deal, and she also has the most experience managing large commercial real estate. She's a couple other apartment complexes. I'm kind of like the numbers guy. And then our other partner, Ryan, he's out there raising money and dealing with the property manager on a daily basis.
Got it. So when did you close on this? You said it was under contract in March. When did you guys end up closing on it?
At the end of June.
Okay. And where are you in the, or actually, let's back up here. What was the renovation plan, the value add plan?
So the renovation plan was, I mean, we need to put about, we're averaging anywhere from 4 to 6K per unit in renovations. And that's to put all new, LVP glue down flooring down. If appliances need to be replaced, that's in the budget. New paint, and then some new light fixtures and like handles for, it's called like nickel. Again, not the renovation guy here, but it's like the stuff you put on your cabinets. Satan nickel, I think. But so it's like five grand on average for the interior renovations, and then on one of the properties, like we completely repainted it, fixed up a lot of the wood rot on the outside, and we're installing a lot of new doors on that property too. And we had to repair a gas leak as well.
Gas leak needs to be repaired. That's for sure.
Yeah.
So, how do the rents? Or you said it was a distressed property? Did you? Where were the rents before the renovation? What do you expect the rents to be post renovation?
Great question. So it's all 1 and 2 beds, and they were renting anywhere from $400 to 550, but definitely earing toward like the lower end, the 4 to 450 range. So right now on the renovated units, we're getting 695 on the 2 bedrooms that we're renovating, and 650 on the 1 bedroom. So on average, it's like a $200 rent bump per unit.
No, that's strong. Were there any expenses you were able to, either eliminate or pass on to the tenants?
So we're passing on some of our utility bills to the tenants. There haven't been any expenses we've been able to eliminate because the seller just, I mean, he ran the property into the ground. Like he was running it at like a 25% expense ratio. And that's why the property was like in such disrepair and mismanaged, because he wasn't putting any money back into it. So our expenses have gone up, but so has our income. And when you take, our current income and our projected income over our stabilized expenses, like our net operating income is going way up over what it was.
Good. Well, that's the plan, right?
Yeah, it's the name of the game.
Yeah. So, what is your uh, where are you at in the time frame here? You said you started June. You're seeing a rent bump, 34 units. Are you going to be renovating all of the units? Are you doing a part of the units? What's the plan?
So we kind of have it broken out in phases. And right now, I'd say we're still in phase one. Because this previous owner didn't do any sort of tenant screening, we had really low economic occupancy when we took over. What I mean by economic is, people may have been living in the units, but they weren't paying. So our occupancy was like in the 30% range, 35% when we took over. We've just gotten that into like the 60 to 70% range. And, we cover all of our bills plus the debt service now. So we have a few more units that were already renovated and we're leasing them up. Once those are leased up, I'd say that begins phase two. And phase two is really just a decision we have to make. Do we flip the property and make a whole bunch of money on the sale right now, or do we go to a bank, refinance out because we're on seller financing right now, and get a construction loan and finish off the rest of the units that need to be renovated and then just cash flow it for 5 years. So that's a decision that our team still has to make, but both of those options are on the table.
Let me ask you. You mentioned the economic occupancy being low, um, and then we've got COVID going on. What's been your or how have you been? How have you dealt with the situation with people not paying and COVID? Have you been able to evict or correct that, or how have you dealt with that?
Yeah, that's a great question. Fortunately for us, most of the evictions we've done have gone through. The tenants haven't even shown up to court, so their case is just thrown out and we win and we've been able to evict them. For some of them, we've had a couple. I think we've had two who actually like turned in the CDC paperwork, meaning they're protected by the moratorium, but they're all on month-to-month leases and they're not like very good residents to begin with. They're like loud, obnoxious. We don't really want them to be part of the community anyways. So what we're trying to do is get them out on tenant holdover. Like we're just not renewing their lease And then if they don't leave the property, we can get them out for tenant holdover or breach of lease, which is kind of the avenue we're going. And there's all sorts of like rental assistance programs out there. So we came up with like a flyer that said like, hey, here's the numbers, here's the emails, like you guys need to call them, and they can potentially help you pay the rent. And we actually just had our first tenant who applied for, where she like filled out the CDC paperwork. She just got a big rental assistance check last week.
Did she pay you the rent she owed?
Yeah, no. Like
Okay.
it came to us. The rental
Okay.
assistant, yeah, they mailed it directly to the landlord.
Okay. I was gonna
Yeah.
say, yeah, that's like that was one of the challenges a lot of landlords have felt was the tenant got the money, but the landlord didn't get the money.
Yeah,
So.
like it wasn't like she got stimulus. This was just like some local nonprofit.
Gotcha. So basically, it sounds like you guys are coming up on completing phase one. You've got it economically viable. It's covering the debt. You're kind of facing a question here: do you continue or flip this thing and go on to another property? Is there a timeline for that decision?
Probably by summer we'll have to make that decision because we closed on it in June, and we don't want to sell it within a year because then we'll get taxed at an ordinary rate. Whereas if we wait for a year, it'll get taxed at the long-term capital gains rate.
Right, right. So let's dive into this a little bit. So we talked a little bit about your partners. Everybody good fit? I mean, you guys talking about going and doing additional deals after this, or is this kind of like a one and done and everybody go their separate way?
That's a good question. I like personally, I think we're all just gonna wait and see like what happens with this deal. I mean, so far I think it's been a good experience for all of us, but none of us have like thousands of units and decades of experience. For most of us, except for the partner who found it, like this is our first multifamily deal. And for the other partners who have like the renovation and construction experience, I mean, they've owned like a pretty large rental portfolio before, but it was in their backyard where they self managed it. So, like, this is completely brand new to all of them. And there's definitely been a learning curve. So, it's kind of like this joint venture was put together pretty quickly to get the deal closed. So, I guess we're just going to see what happens when it's all said and done.
Got it. So with that, is there anything that you would look for going forward when you're looking for partners?
Well, I mean, you should be looking for people who have similar values to you and then have, skill sets that complement yours. So, like, for me, it'd be great to connect with someone who, like, is great at managing construction contractors and renovations because I don't like doing that. And then capital is just a huge part of this business because if you go out and you're buying 200 unit properties, which is where I'd like to go, I mean, you're talking about you're going to need to raise millions of dollars.
Right, right. Um, what about looking forward for deals here? We talked about you'd been in a couple and realized that multiples were the had a much better advantage as opposed to the singles and or flipping. Um, and you mentioned that Arkansas was kind of on your radar, but not necessarily Little Rock. Is there anything that you can point to as far as lessons you've learned or things you'd look for going forward and when you're looking for a deal?
I mean, so when I'm looking for a deal or like when I'm looking at a market?
Well, deal and market, I guess.
I mean, when I'm looking for a deal, there's a lot more due diligence I would do going in next time, especially really all due diligence, physical due diligence and financial due diligence. And you can't know what you don't know until you've actually done it. I mean, I know a bit more about like construction and renovations now, so I mean, I'd be going there with like multiple contractors, my property management company, and ideally an inspector, and just getting all of their perspectives and really questioning the contractor, like how are you coming up with your bid? Because if you're just going to throw out a number, like I need to know what that encompasses. so I can make my own decision whether it's enough to get the work done. As far as like identifying the market, it's interesting because like this deal, it's not in a hot market, but I would do another one like it again, even if it's not in like a high growth market, just because the spread on it is so great. I mean, we're talking about being all in for $35,000 a unit, which includes all the holding and the soft costs, and selling for 45 to 55 or refinancing at that value. Like if it works out, all of our net worths are going to grow a lot. So I would definitely consider something like that in a more stable market. But really like Florida too, and I have a partner who lives there. He's boots on the ground, and that's just got like all the demographics you could want in a market.
No, that's definitely both of those. Finding the deal in the markets. I mean, I'm kind of curious. Any thoughts on the market based on the COVID experience? Is there has COVID changed your thoughts on where you might look for a property?
Yeah, it actually has. I was kind of really hell bent on being in these big primary markets before COVID because that's where all the jobs were and people weren't working remotely as much. Now, though, I mean, it seems like the trend is people are moving away from these big major cities, especially the high cost of living ones like New York City and, pretty much everywhere in California. And they're moving to places like Florida and Texas, the Southeast, where it's more affordable to live. Taxes tend to be lower. And now you have all this remote work, so you can kind of live wherever you want. And heck, like I moved to Denver earlier this year because I still have a W two and like I can work remotely now. So I'm just like I want to live here. I'm going to move. So I think finding markets too where there's just like things to do and people want to live. So in the southeast, you have warm weather and beaches. In places like Colorado, you have the mountains. So like looking for attractions like that with still a strong employment base and a strong economy, I think that's going to be pretty key to identifying markets. And you could probably pick some great small tertiary markets that way.
Got it. Um, the skill sets. What do you see as the skill sets you have to have, whether it be you personally or on your team, in
Mhm.
order to get into your first deal and be competent?
So I think there's like three legs to buying big commercial real estate. You have to be able to find the deal, you have to be able to manage the deal, and you have to be able to raise money. So if your team has all of those legs filled out, you're probably a rock star team. With the guys I work with right now at Kronos, that's our company. I think we do a great job at identifying the deals because I think we're really strong at analyzing the deals, and we're definitely picking up our ability to raise capital. And through this experience in Little Rock, now we have real asset management experience. But if you're just starting out, at least like what I would do is I would focus on one of those legs and then pick like a skill set within that leg. So like for me, it was finding deals, and then I'm a spreadsheet jockey. So part of finding deals is being able to analyze them and identify them. So like I focused on that. If you're really good at developing relationships with people and networking, maybe you're the one who's talking with the brokers and developing those relationships, or you're the one talking with investors and raising money.
Yeah, no, makes sense. Yeah, I mean, definitely three critical pieces there, and having people that are strong in each of those would definitely propel the chance of your success. That makes sense. Um, John, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there are three strategies we typically consider. The first is we look to see if we can avoid the risk. If we can't avoid it, then we look to see if we can minimize the risk. And when neither of those are options, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And I like to ask my guests, if they can look at their own situation, their investments, their clients, the investors in their deals, tenants, the market, interest rates, however, you want to identify, the question for the answer. But I'd like to ask you about biggest risk. And for clarity, I'm not necessarily looking for an insurance related answer, but if you're willing, I'd like to ask you, John Stoeber, what is the biggest risk?
Right now, I still think COVID and just the environment we're in is the biggest risk, especially if you're dealing with C class properties. You tend to deal with residents who are on the lower end of the socioeconomic scale. So these are the people that, they're servers, waitresses, receptionists. They actually have to go into work. So if there's a shutdown, like they're not going into work, or if they get COVID, like they may not have a job anymore. So I think that is a huge risk, like from a property perspective, but also with this, like the whole market right now, and it's February 2021. Like the whole market just seems crazy. If you and your listeners have been like paying attention, I mean, just look at GameStop, AMC, Dogecoin. It's just like it seems very unstable right now, kind of bubbly and frothy, and like I don't know if the lending market is going to be the same 12 months from now where people are able to get loans so freely. And if you can't get loans, that really drives down the number of buyers who can buy a property, which in turn is going to drive down values.
Yeah, no, that's definitely some things to pay attention to, and hopefully they don't come to fruition there as far as the negative effect there. But always a risk there. That's good.
Mm-hmm.
Hey, John, where can the listeners go if they would like to learn more or connect with you?
Yeah, I'm pretty active on Facebook and social media, so just reach out to me at John Stoeber or on Instagram at John_Stoeber. You can check us out at our website, chronosinvestmentpartners.com. We have our own podcast called the Millennials and Multifamily Podcast, so you can check that out. And we have a free book called How to Analyze Big Apartment Buildings and Make Them Feel Small.
Cool. Tell me how to spell the Coronos there. The
KRON as in Nancy OS.
Got it. Got it. All right. Well, John, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Yep. Thank you so much, Darren.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.